Good afternoon and welcome to the latest Yellowstone Advisory webinar with Checkit plc. Before I hand over to the presenting team, I just wanted to go through a few admin points. You're all currently on listen-only mode, but if you do want to ask a question, please type it into the chat box at the bottom of your screen. We've had a few questions sent in ahead of time and we'll cover all questions at the end of the presentation. The format today is a presentation which will last approximately 30 minutes, and then we'll have 20 to 25 minutes available for Q&A. And then following the meeting, you'll be redirected to a short anonymous survey, and it would be really appreciated if you could spend a few minutes completing that. I'd now like to hand over to Keith Daley, Executive Chair of Checkit plc, to start the presentation.
Well, good afternoon, everyone. This is the 2021 Checkit annual results presentation. My name is Keith Daley, Chair of Checkit, and I'm delighted to introduce Aylsa Muir, CFO, and Kyte, our Chief Commercial Officer. What is Checkit? Checkit is the connected digital assistant for operational workforces that enables agility and intelligent decision-making in large and complex organizations. Our strapline is optimize performance everywhere, and our ambition is to be #1 in operational management systems for deskless workers worldwide. Such workers form 80% of the global workforce. Checkit is the future of intelligent operations and will, we believe, increasingly be a must-have within our target markets. We tackle problems and pain points in operations currently underserved by technology. Checkit has a unique proposition, is constantly developing, and is already in use by far-sighted, large and complex businesses. So the next slide is a disclaimer, which I will leave you to read in your own time. And now I'd like to hand over to Aylsa.
Thanks, Keith, and good afternoon, everyone. So 2020, a year I'm sure none of us are going to forget in a hurry. And that was no different for Checkit. So I'm going to take you through the next few slides and have a look back at our highlights coming out of FY21 and talk about how in Checkit we met the challenge head on in the last year. So I'm going to just talk through some of the key financial highlights from the last year. And in a year of so much uncertainty, we started this year, like many companies, with our growth plan stalled and our budgets pretty much thrown out. And Checkit was absolutely no different. What was really important, though, was that we made some good progress on our ambitions. And that's the ambition that Keith talked about up front. We've got some very ambitious plans ahead of us. So making progress on that was absolutely crucial. So I'm going to start by talking about the progress we made on last year. Revenue grew really slightly in FY21, up 3 percentage points at around 13.2 million. And if we consider that at the start of this year, around half of our revenue portfolio sits in non-recurring revenues, which depends on engineers getting on site, this was really significantly impacted, particularly in the first half, by the lockdown. So actually, with that in mind, any revenue growth this year, considering that mix, is seen as a positive. And we can understand why when we look at our annual recurring revenue. So annual recurring revenue, or ARR, is the contracted live customer revenues, and they're seen as our most important indicator of true sustainable growth. We grew ARR by 46% in FY21, and I'll talk shortly about some of the levers within that. That meant that we didn't only secure a longer term revenue stream, but we more than offset those declines that we saw in the non-recurring revenue that was caused by the pandemic. So as with other businesses, securing new sales was really difficult in the year and was a bit of a challenge. So considering the headwinds we were up against, a good result overall, top line. Operating loss closed at 3.1 million. This was an improvement of more than 50% on the prior year. And that wasn't only due to those moves that I've just talked about in revenue, but a real testament to the way that the business in the first half of the year reacted to the pandemic. pulled back on non-essential investment, preserved cash, and really took that immediate action to preserve margins while we all understood what we were going to come out of the pandemic like. We then, in the second half of the year, really started to grow the operating model and rebuild that for growth in a better way. And all of that work you can see coming through in the improvement in gross margin. And that's really reflected there with this 8.5 points of gross margin improvement year on year. That's not only that operating model, it's the work we've done on revenue. And I think it's really testament to the work that the business has done and how it's responded to the pandemic. A few other points to pull out from a financial perspective. Cash remains still strong. 11.5 million was the closing position at the beginning of the year. We entered this year, and we did benefit from closing down some of those other legacy items and asset and shares, etc., from the Electron days. So that happened in the year. But another really positive thing was we were able to maintain our level of investment in new product development. We spent around 2.5 million in the year on our products, and in a world which we are seeing digital accelerating at an incredibly fast pace coming out of the pandemic, this was absolutely crucial to us to ensure that we could maintain an advantage and come out of the pandemic ready to address the addressable market, which Kit is going to talk to us about shortly. So in summary, I suppose a really pleasing set of results and a real balance of long and short term being addressed as we navigated our way through quite a difficult year. So now I'm going to talk about revenue and ARR. As a software business entering into a scale up and growth part of our life cycle, revenue and ARR mix and growth take absolute center stage as indicators for sustainable value for shareholders. So a couple of slides to really look at revenue and growth a bit more. Firstly, I want to talk about our revenue by type and how we segment that. So we have recurring revenue. This is our multi-year contracted high retention revenue, repeatable revenue. So there are elements of our revenue base that are less than a year, but pretty predictable ongoing service work for customers, and then non-recurring, which really is the other project pieces of work that are once-off in nature and one on a case-by-case basis. So again, we've managed to really shift the mix on our revenue, and this is all to do with the way that we are accelerating our software as a service and subscription-based pricing model. We moved around 10% of our revenue into recurring, and what it meant was that we closed the year with more than 50% in either recurring or repeatable, predictable revenues, and that's a switch from where we were at the beginning of the year. When we look at our ARR, as I talked about before, this strong growth in ARR, there were 3 levers that we pulled really to look at to get ARR growth in the year. We were able to secure around 700,000 of new subscriber business, and that came from a mix of new logos, predominantly new logos, but also existing upsells. So this is net new business that we managed to secure and get live in year. Then there was a program of conversions. We've talked about this a lot in our communications and our RNS, but we managed to go on a program to convert a number of our healthcare customers into a much more all-encompassing subscription-based model. So really transferring and converting some of that repeatable non-recurring revenue into a one subscription model for our customers, and that is the preferred model on which we sell now. And then finally, as part of this work and some of the work we've been doing around our commercial strategy and our pricing and positioning in the market, we were able to take around £500,000 of ARR growth from pricing in the year. And that was part of a whole harmonization and really looking at our contracts and commercial offering in the market. So this then meant we grew 46% in the year. We closed our ARR around 5.7 million. And what's really important is we took some really valuable learnings from that we can use, particularly on the back of the US acquisition. And I know Kit will talk to you a bit about that shortly. And then finally, I just want to cover our segmental analysis. So in our interims, we talked about the creation of 2 new business units, business segments. First of all, I'll talk about Checkit Connect. Just as a reminder, Checkit Connect is the high growth SaaS recurring business unit. It's where we tend to invest into sales and product, etc. And that's where we saw that 46% ARR growth in the year. That translated into around 33% of recurring revenue growth in the year as reported. And then you can see that decline in non-recurring revenue, which was an intentional switch of our Checkit Connect customers to this pure subscription model. And that's something we will continue to do as we really look at getting that revenue tied in. And I'll talk about Checkit BEMS. Checkit BEMS is the building and energy maintenance systems, management systems for business. So this is a legacy business that was acquired when Next Controls were acquired, and it's the profit center, the profit center for the business. Revenue in this area is mainly once off. It's highly skilled engineering work with large customers, and it's fair to say was the most impacted at the beginning of the pandemic, particularly when construction was locked down as part of the first phase of lockdown. So hence why we're seeing this decline year on year. It's worth noting that we definitely saw run rates return the back end of the year. And certainly when construction, we're fortunate that construction hasn't closed again, and therefore we're able to maintain that run rate. So two very different business units performing their role in the business, but overall certainly moving in the right direction against our objectives. And then finally, on the financials, I'm just going to talk about cash. Cash absolutely crucial for us and every other business, certainly in the last year. Our ability to hold cash above 11 million at the end of the year is very positive. When you look at the drivers in cash flow, our ability to realise some cash inflow from the sale of some of those assets and shares. Actually, our cash drain on the year was under 3 million, and that was predominantly from operating activities, of which 2.5 million of that, just as a reminder, was actual investment in the future in new product development. So that concludes the financial highlights. But what I do want to talk about now, I'm now going to move into, is alongside this great great set of financial results, we've also got a huge amount been going on in the organisation itself in Checkit since we last spoke at the interims. So I'm going to talk a bit about transformation, and we hear a lot about this, and when we will hear from Kyte shortly about the size of the market opportunity and how we're really going to get after it. What we've been doing after a period of enormous amount of change for the group is really focusing down on how we transform ourselves and position ourselves ready to be able to get after the growth. So I'm going to just talk to you about some of those key pillars that we've been looking at. Let's start with business redesign. We've already heard about the creation of 2 new business units. It's really important that business units have clear KPIs, clear targets against our set of strategic objectives. Every function has or is still going through some kind of transformation and reconstruction following the change in the corporate structure over the last 2 years. And there are 2 things in mind when we're rebuilding and redesigning the operation. One is scale and growth. And the second one comes to our second pillar, which is about going global. We are on the road to establishing a strong global operating model. Internationalization and being able to scale at speed and overseas has got to be at the heart of our business redesign for us to be able to position ourselves, as Kyte talked about at the beginning. This was all accelerated in the first quarter of this year by the US acquisition that you will have read about and the appointment of Steve Peck, who's our new US managing director, who's going to be really putting the efforts into getting after the US market. And finally, customer centricity, customer retention, growth, advocacy, really important, and they're at the absolute core of a software as a service business model, not to mention a company such as Checkit, who's really positioning itself in this emerging market space for the underserved deskless workforce. So it's really important for us to change the way in which we engage with our customers, to ensure that we offer ourselves as strategic partnerships, gold standard service. All of those things are really important to us. Kyte's going to talk a lot more about that, about how we bring that together and go to market. And we talk about our proposition later, but making our organisation truly customer centric has also been really important. And then we can't talk about transformation without talking about people and our culture. There's the transactional part that we can do in terms of transforming, but really it's about all of our people, and nothing's possible, including the results, without the people in the business. This is a business that's been through an enormous amount of change. I think it's fair to say that the resilience and professionalism of all our employees is the reason we delivered the results. And our culture is really crucial to get right if we want to be able to achieve our ambitious goals. And this all started with that vision. Keith talked about it up front. This is a vision and a goal that unites us together. It's been backed up with strategic objectives, operating plans, and every team really understanding their role. That was really key. Secondly, we've introduced some new values into the organisation. So these are our employee values that really set the standard for what we expect of ourselves as we try, as we go for our strategic goals. The good thing about these was that these were values that were created by our own employees who from across the group came together to really decide and agree what expectations and standards we wanted to set for ourselves. We've been able to recognise some of our employees. We've introduced Checkit champions into the organisation and really rewarding those behaviours that are going to help us meet our objectives. And then finally, people themselves. All the eligible employees have had the opportunity earlier in the year to participate in the new EMI stock option scheme, which was really well received by our employee base. We've welcomed new talent into the business this year. We've recognised and made some real progress on our diversity statistics and some of those areas around environment and corporate social responsibility. I think it's fair to say we're at the start of the journey of that, and that's part of our culture, and you can certainly expect to hear a lot more, but employees, absolutely crucial. And that kind of brings me nicely to the next page, which I wanted to talk about because this is a new management team. And the reason it's really important, this is the senior management team running the business. And if you look at it, I think only 2 people on this slide have actually been here more than a year, and that's myself included. I joined in July. This is a new dynamic management team who, considering a lot of us have joined the business on a remote basis at a time of such change, really are setting the tone and the delivery and execution against that vision. These individuals will join the business. They are experts in their field. They are experts in software as a service and how to grow that type of organisation. So I'm really excited myself to be working alongside this group of individuals. And that's a good opportunity, I think, for me to hand over to my colleague Kyte, who obviously joined the business very recently as our Chief Commercial Officer. And he can talk to you about the future opportunity and growth.
Thanks very much, Aylsa. Yes, so there are a number of questions that keeps the C-suite awake at night. CXOs, CXO-1 business leaders, for example, and what we've seen is that COVID's accelerated the urgency and the importance of some of these questions. For example, are we responding to change, but not just change? How agile is our operating model to environmental shocks? Are we growing revenue? Yes, but how can we drive cost out? Where's revenue leakage taking place? Are we delivering our services? But what is our business continuity plan? And how do we make that more flexible? Can we adequately report on our business? Do we have the insights, the analytics, and the data to be able to make those executive decisions? And how compliant is our business? Do we have the transparency with which to show it? Checkit has a role to play in each of these questions and more. And we do this because we make our clients' operations intelligent. And by so doing, we empower them to unlock better insights, better visibility into the execution of daily operations, but also to make their operating model agile and adaptable. We help our clients gain visibility and better control of revenue generating opportunities, revenue leakage, stock management. And throughout all of this, the transparency that the Checkit platform provides enables much better audit and compliance. This reduces the risk of human error and wastage. It's very powerful for organizations in a lean world. So how does Checkit actually work? How do we do this? Well, we see this as a life cycle continuum, and it's something we call the 4 C's. So capture, connect, collaborate, and comprehend. I'll just take you through how that works in reality. So capture. We capture data for our client's organization, for our client's operations, and we make it digital. Typically, on a widely dispersed, decentralized workforce, there are a lot of activities that are happening in an analog way, or an ad hoc way, in a paper-based way. disparate Excel spreadsheets, but it's none of it's speaking to each other. By putting the Checkit platform inside our clients' operations, we capture that data and we make it digital. So by doing that, we already start the journey to connecting workplaces, employees, operators, all under one digital roof. Once you've done that, your employees and your operators are much better able to collaborate in real time, armed with the Checkit app or memo linked into the platform and the IoT ecosystem that surrounds that, providing continuous data feed. These employees and these operators are much better able to react to change, but also to complete tasks and activities in a more effective manner. And we gather all these data points in one place and provide operational and strategic level insights, analytics, and visibility to allow senior stakeholders and decision makers to influence change at the operational level and feed it back into the system. So broadly speaking, Checkit does this in 3 ways. We manage activity coordination. Okay, so we help manage, guide, and execute operational processes, playbooks, and activities across workplaces. I mentioned the IoT ecosystem and the way that the data feeds into the operational platform. This helps us better manage escalations within a client organization. So imagine a frontline worker automatically receiving an alert from an IoT device that then triggers an activity and action they need to take. They can then do those things, evidence they've done them, and do it in real time and share it with others. And all of which, as I said before, generates a vast amount of data, which provides much more granularity around operational analytics. And then decision makers at the regional and the senior level can then make real-time decisions to influence better outcomes. So I think just talking about the product, we're very excited about this product, and there's a number of developments, as you can imagine, in our product roadmap, but I'll just focus on 3 for now. We've, as anyone who saw the RNS release last week will have seen that we've just released our easy install feature for IoT devices. In essence, what this does is it allows for much more self-service oriented scale out for our clients when delivering IoT devices operationally and globally. This reduces the need to rely on external third parties and engineers, and obviously reduce costs. And there's a net benefit for Checkit as we expand into other markets. Our alerts to jobs feature is very exciting. It's due out in the next couple of months. I talked about previously the IoT devices and the ecosystem that surrounds our platform. Well, whilst they already provide automated monitoring, what we now do is the automated monitoring is captured into our platform and automatically fed into the digital assistant and the apps that your operators will have in their hands, and then triggers an immediate next best action. And so, to our knowledge, there's no other provider in the space that's managed to automate the data feed into a platform that triggers jobs and activities. So it's very exciting for us. And again, with an eye on the US market, we've accelerated the rollout of our Apple iOS app to complement the Android app and the web browser version that already exists. So we then have a full product suite as we look to scale up in the US. And we think this is significant given US adoption of iOS devices, but also for the market opportunity that sits over there. So we're very excited about these developments. Aylsa touched upon the market opportunity. I'm just going to spend a moment just describing how we see the market opportunity. Really, there's 2 sides of a coin. You've got the knowledge worker side, your typical enterprise employee who sits behind a laptop all day accessing different digital apps and digital processes. That is a very well-served market. It's very well penetrated. Favorite brand names, Oracle, SAP, Salesforce operate in that space. We target the 80% of workers who are not knowledge workers. That we estimate that to be about 2.7 billion deskless workers. That is our market. And when you look at it, on the right-hand side, you'll see there's a range of different sectors that we've put population estimates on. Checkit's already present and active in healthcare, retail, restaurant, and hospitality, which is over 800 billion employees already, for whom we can have an effect. And so we see this as a very exciting space. And as you can imagine, there are adjacent markets that we can expand into over time. So the way we split this up, we focus on 5 different industry verticals: healthcare, food retail, franchise, pharma, and facilities management. What's really interesting about Checkit is that the platform is really easily configurable. It's low code or even no code. And so therefore the use cases amongst these different industries tend to be quite similar. For example, the compliance use case, labor productivity, workforce management, inventory management, production planning, and indeed brand standards become challenges that we see across different industries and use cases. And if I just pause on healthcare, for example, it will not surprise you in the last 15 months, we've been particularly active in the healthcare industry and indeed in the NHS itself. And the complement of our advanced temperature monitoring IoT devices in fridges and freezers, monitoring vaccines, bloods, etc., has helped drive significant time back into the system so that nurses and ward managers can devote more effort to patient outcomes. Of course, when they link that into the Checkit Connect app, that further helps them reduce the need and the reliance upon discrete manual repetitive activities, again, freeing up time for patient outcomes. It's very exciting and it's a high demand area. So exploring how we segment that market, how we actually grow. And we split the market into 4 tiers. Tiers 1 being £1 billion plus revenue global enterprises. Tier 2 being 100 to a billion. Tiers 3, 10 to 100, and tiers 4, less than 10 million. In Checkit's evolution, we've grown from a company that was doing short cycle transactional business in tiers 3 and 4 to focusing now specifically on tiers 1 and 2. And what we see with tier 1 and 2 clients, large enterprise clients with big global operational footprint, is that this requires a consultative solution-based sale. And we've been investing accordingly. So our front-end sales teams and marketing teams are all bringing professional services, large digital transformation experience. We call them enterprise transformation partners, or ETP for short. And this is how we then go to market. We see 2 types of sales cycle with the assets, with the product features that we've got. We see the Checkit Connect platform sales cycle being somewhere between 6 and 9 months at the moment, with efforts to drive some time out of that system. And then we have a short sales cycle, which is around the IoT devices, depending on which product we're leading with. And the IoT devices can be 2 to 6 weeks in length. So what's great about that is we have a combination of short sales cycle and medium to long-term sales cycle, which better helps us forecast ARR and opportunity mix within these different clients. So with an eye on going global that Aylsa mentioned, we've recently completed the acquisition of Tutela LLC in the US. The US market represents a significant opportunity for Checkit, in our opinion. The good news is we've already been able to convert a number of existing customers within the Tutela LLC company to recurring revenue contracts. That further enables us to upsell our platform into those customers. And we're at advanced stages of conversation with food retail and large food retail and franchise names with our Checkit Connect platform. I'm pleased to say that the demand is there, and we see the US as a particularly strategic growth area for Checkit. Elsewhere, you'll note that we've expanded into a number of different countries into Europe, as well as Asia Pacific, Australia, and New Zealand, as we continue to roll out global delivery for some of our global clients. This is great because it helps us better harden our product, harden our delivery service, and thinking about the product features in terms of self-install for IoT devices further credentializes us as a global technology player. So in all, there's a lot of investment on the go-to-market on the front end and how we start to deliver at scale. And it's a very pleasing time, a very interesting time for Checkit as we look towards the back end of COVID and start to ramp up our activity. With that, I'll hand back to Keith for some final thoughts.
Thank you very much, Kit. So we're almost at the end of our presentation, and it's time to sum up. So the post-COVID-19 acceleration of digital presents a significant opportunity for Checkit to lead in an underserved space. The Tutela LLC acquisition is a critical move to capitalize on the US opportunity. And following the doldrums of COVID, we're now coming out of that, and a revitalized go-to-market strategy is showing promising early signs. And a strong business performance provides us with the ability to accelerate our ambitious growth plans and invest more into sales and marketing. As far as full year 22 is concerned, you'll remember our year end is the 31st of January. This has started well and the management team remains confident. And the next time you will hear from us will be when we issue our FY22 quarter one trading update on the 13th of May 2021. So now I'd like to turn to the questions section of the presentation, and I'll ask Alex to get out his list.
Well, thank you, Keith, Aylsa and Kyte for that very comprehensive presentation. We are now, as Keith said, going to go to the Q&A section. And just as a reminder, if you would like to ask a question, please type that into the Q&A box at the bottom of the screen, and we'll try and get through as many questions as we can in the time available. And I'll just start off with a question here. Despite good revenue growth, the business is still unprofitable. What revenues do you need to generate before the company gets to break even, and how long do you think this will take? And I guess linked to this, is the cash pile retained from the Bulgin sale sufficient to see the company through to profitability?
Okay, so I'm going to ask Aylsa to answer that question.
Yes, certainly. So I think we've talked about before, this is a common question for us to be asked. I think the thing to note is that we are a young technology company, and therefore this investment that Kyte talked around into product and growth does mean that we run at that EBIT loss. There are plans, we're accelerating that. That does mean that we're looking at investing in the top line. There's still a plan to get to profitability in around 2023. So that still remains on our horizon, and we absolutely believe that the cash reserves we have at the moment are sufficient to get us there.
Okay. Question now talking about a specific client on BP. Can you talk about the BP contract and how that's going? How many locations do you have Checkit installed in the UK, and which countries outside of the UK are using or trialing Checkit?
So I'll ask Kyte to answer that one.
Thanks, Keith. So yeah, I mean, we'll not go into specifics about the BP contract. What we can say is that it's a very good partnership. What we can say is that we've expanded with BP across a number of locations globally, and it's a very exciting time. You know, it's a very strong partnership, and there are aspirations for further growth.
Thank you. You talked about in the presentation the success in the NHS, and the question now is what proportion of revenues does the NHS account for?
Aylsa.
Yeah, thank you. It's around 30%, or just over a third. Obviously, that we've been growing that a bit over the last year with various activity, but around about a third. Okay.
Here's quite an in-depth question here. Checkit's monitoring technology workflow tools are currently being used in about 43% of the NHS trusts. This is a very significant achievement for a company of your size. Please, could you tell me what growth rates and penetration you're foreseeing for Checkit's monitoring technology workflow tools in America, where medication-related errors are responsible for direct annual costs of over 20 billion and medical liability costs of more than 13 billion?
I think Kyte.
Very detailed question indeed. Look, so yes, as I alluded to earlier, as a result of, not just a result of COVID, COVID's accelerated indeed the value proposition as it relates to the NHS, but healthcare more broadly. So yes, it's pleasing that we've got both our IoT ecosystem and our platform at work and at scale inside the NHS and other clients. I mean, I think as it relates to the US, I mean, it's obviously worth bearing in mind that we only made our finished acquisition about 2 months ago. So yeah, there are very promising early signs. With that acquisition came an existing predominantly healthcare pharma base, and you know, what we can say is that that's still a very underpenetrated market. It's what I would potentially call low-hanging fruit, and represents a very good opportunity. We have a blueprint for success, given how we've already been driving this in Europe, and we're very bullish about the opportunity to address those challenges and pain points inside the US healthcare system with our products.
Okay, thank you. We've got 3 questions on competition, which are quite similar, so I'm trying to ask them together. And I guess the gist of the questions are, who are your competitors, and what do you believe is your competitive advantage? And I guess specifically, there's one particular competitor has raised £6 million to do things similar to you. Could you comment on that?
Well, I'm unaware of the particular competitor. I point out that we have spent probably in terms of running the business, getting the business to the current state. Probably, well, let's give a broad range between 20 and 30 million. So there've been some big bucks actually spent in getting to where we got to, and also we continue to have development plans, and I think our customers value the fact that this is not a static product, that it's constantly developing. As far as competition is concerned, there is no one that directly competes with us in everything we do. There are people that compete in parts of what we do, and obviously we analyze them. So when I'm asked this question about competition, I tend to find it quite difficult to answer, because the answer is in one sense no competition, but in another sense many competitors. Kyte, perhaps I should at this point throw it over to you and make a bit more sense of it.
Yeah, thanks, Keith. I mean, look, this is a fragmented marketplace in that you've got a number of relatively small players who offer endpoint solutions. For example, we can solve your compliance challenge in your distributed operations, or we can solve your workforce management or scheduling challenge, but nothing else, right? So with an eye on the US, there's a couple of competitors in the US who are VC-backed out of Silicon Valley that have started to expand into more than one use case offering. I think the opportunity there is for someone to be able to offer more end-to-end solution, right? An out-of-the-box platform that can solve all of those use cases I mentioned earlier. And that is what Checkit's being built around and being designed around. So I think that elaborates further on Keith's point. It's difficult to say that we have any out-and-out competitors. There are certainly adjacent competitors, but it's the opportunities there to offer something more end-to-end, more holistic. Because in speaking with a lot of our clients, they really don't want to deal with 2 or 3 vendors for a common challenge and use case. They do want one proper vendor who can provide the solution out of the box.
Okay, we're going to move across to personnel matters. Question here says, I'm an investor in the company since before the corporate restructuring and wanted to ask about the board of directors. You seem to lack key roles like a chief executive, a chief technology officer, and perhaps a marketing sales role. Please, can you explain? I think you touched on some of this during the presentation, but maybe if you could just add to that now, that would be great.
Okay, so I'll draw that all together. So you're right, we don't have a chief executive. However, we do have an executive chairman, namely myself. So you could say I'm chairman and chief executive, but I don't actually call myself as such. As far as other roles are concerned, the chances that anything is required, we certainly have. And to give the example of the CTO or Chief Technology Officer, we do have a CTO. He's just not on the board. And as far as sales and marketing are concerned, again, we've had sales and marketing executives, but Kyte is now our Chief Commercial Officer, and all of that stuff falls under him. And that's an area of massive focus this year, to really get ourselves in a position so that we can start to scale. Have I answered enough, Alex?
I think you've done a pretty good job there, Keith. Yes, I'm going to add a sort of a follow-up question, which has come in just on the board composition, and saying that you've had a departure in the healthcare sector, and would this slow down your healthcare market development?
Kyte, perhaps I should ask you that.
Yeah, thanks. I I mean, I have no comment to make on the departure, but all I'd say is that the healthcare market development, if anything, is accelerating. We see an increasing fit between our product and the challenge around freeing up better time for patient outcomes, reducing the manual burden. So no, I mean, and as a result of COVID headwinds, that digital adoption agenda has never been more pressing, certainly in the NHS, which most of us here we're familiar with, but also across healthcare operations across the world. So yeah, it's only accelerating in our opinion.
Yes, and I would say that you know, I'm obviously very grateful for all the work that Rachel has done, and she is continuing to provide us with valuable NHS contacts, and there's no reason to believe that would change even if she leaves the board. But we've still got her up until I think it's the 3rd of June, which is when our AGM is.
Okay, thank you. A couple of specific questions here. Is it the facilities management product that is supplied to BP and John Lewis? And do they pay an introductory discounted rate? And if so, when do they start to pay the full rate?
Well, we can't obviously go into customer pricing because that's confidential, both from our point of view and the customers. The product is designed to fit across a number of verticals. You know, it's not necessarily vertical specific. So I wouldn't actually say there is a facilities management product, but it's all about workflows. Again, Kit, do you want to help me out on this one and comment on that?
Yeah, sure. I mean, look, as Keith said, it's a single platform that's very configurable. I mentioned before, there are some quite common use cases. So there's common set of use cases in facilities management, food retail, franchise, very similar, and the platform just configures to that. You know, the differentiator is the way that you capture processes and digitize them, and then the platform just enables those to function more effectively through the hands of your operators and through the platform itself and the data it gathers. So it's infinitely reusable as long as the use case stacks up.
Okay, I've got a linked question to that, which is probably to you, Kit, which is how much customization is required as you move from client to client, and how much of the product is standardized?
Well, exactly as I just said. So the product doesn't require that much customization at all. There's two areas, and this would be typical for any platform. And one is to ensure that the processes we're solving for our specific clients are captured in the right way, and our teams work with that. That's a small bit of customization work. Although what we have is an ongoing and building process library. So as you'd imagine, certain industries have common processes and ways of working. So as we build up the process library, it becomes even easier and even less of a customization effort, because you can then offer a process and it might be 80-85% complete to what a client wants to do, and they just tailor accordingly. So that's that bit. And then the only other piece of customization, which is relatively lightweight, is on the insights and analytics dashboarding that we provide. Again, we just design, we have the functionality, and we just top and tail it with certain requirements that our specific clients want. If some want to understand much more about compliance, others want to understand much more about productivity or time saved, we just tailor and adjust accordingly and then release.
Okay, let me pick up another question here. Do you engage with the commercial insurance industry as a way to accelerate your market penetration?
Well, we have done in the past, and it's purported to do that, but frankly, it hasn't resulted in much business. So we're not currently engaged in any of those sort of discussions.
Okay, this sounds like a question for the trading update on the 13th of May, but I will ask it anyway. You mentioned you exited Jan 21 with a ARR of 5.7 million. What has it grown to in the first 3 months of the current year?
Well, we
can't. Yeah. Sorry, Aylsa, do you want to?
No, it's okay. Yeah, sure. Well, tomorrow marks the first 3 months, so we haven't got our results ready. But yeah, you're absolutely right. That will be our ARR position for Q1 will be published on the 13th of May with our trading update.
Okay, and then a linked question to that: do you have a 5-year ARR target?
We absolutely do. Do you want to say anything more about the annual operating plan?
Yes,
Aylsa?
I mean, I think I talked about it quite a bit in the presentation, but there's a whole strategic, the refresh and reinvigoration of the strategic business plan that talks about where we want to go. I'm not going to talk about specific numbers. You'll see that there is guidance or analysts reports in the market around 22 and today 23 as well. But yeah, I'd say that we've definitely got ARR targets, and they absolutely are supported to support those growth and ambitious growth plans that Keith and Kit have both talked about.
Okay, thank you. The business offering is split between IoT and SaaS, with the facilities and real estate industry immature on data and IoT, and there being a huge opportunity here. Where do you see the quicker path to revenue? Is it SaaS and CWM or IoT?
Right, so I don't think we can review this as either or. So the way to look at Checkit is that there's the core platform, which is around people management, and you can regard the IoT side as, if you like, plugins to that. So there is, although the website might give a different impression, it's getting a bit long in the tooth, and we're going to be refreshing the website shortly. So, we're moving very much towards one product, I would say, and different industries will have a greater or lesser need for the IoT side of things. We've also got obviously building management as well. I should probably stop. Kit, do you want to say anything about that from a sort of marketing point of view or market point of view?
Yeah, sure. Yeah, I mean, I think just building on this, it is not an either or. Our front end teams are equipped to sell either leading with IoT and bringing in the platform as part of the same sale, or vice versa with the platform and then bringing an IoT ecosystem around it. As far as buildings and facilities work management, absolutely, it's a huge target area for us. I think just this idea of connected operations, smart buildings, feeds very much into the Checkit value proposition, because you need smart buildings, you also need smart humans, and that's what the platform enables them to do once you've got the assets being recorded and the data feeding into the system. So I think that, again, that for us is a point of difference.
I've got a follow-up question on competition, I think, here, which is, where do you see the threat to Checkit in relation to companies such as Honeywell, who have their own NOC and do their own IoT services?
Well, I think the short answer is we don't see a threat at all. I mean, Honeywell comes from a sort of kind of control area. We start with the customer problems, and it's about all of operations, I would say. So we have a wide kind of remit. So our aim is to cover everything that someone in operations might want to see, whereas perhaps Honeywell is perhaps a bit more restricted. Again, I suppose I'll defer to Kit on this one as well.
Yeah, thanks. I mean, again, the analogy I draw here is, if you think about when I mentioned about the knowledge worker side of the industry or of the market earlier on, over the last 5, 6, 7 years, you've seen the rise of a lot of digital automation, and companies like UiPath and Automation Anywhere. Around that same time, enterprises, because I was working in this space, enterprises were trying to build their own product to compete against this, and oftentimes the life cycle was to build and then fail, spend a lot of money, and then realize you needed to have someone who's specifically focused in delivering a product that's hardened our value and has had it tested across different industries. I think it's a similar proposition over here with Checkit and the Checkit platform. We do come across clients and companies that have tried to build their own tools, and oftentimes they go back down this endpoint solution. And then so it can solve one thing in a slightly ad hoc way, and it's not really bringing the agility, nor the transparency, nor the effectiveness the clients want. So it's not really a concern. And I think if anything else, we end up as a complement. We just feed in what they've built, and we just expand that across the company's operation.
Okay, thank you. Given the current COVID-19 healthcare crisis in India, does Checkit have any boots on the ground there, and are they seeking monitoring technology workflow contracts?
I suppose I'll answer that. Well, as it happens, we do have a kind of legacy subsidiary which we're winding down in India. In the past, the company has had, some kind of business dealings with India. India, we will go where our large clients want us to go. I would say, if we were to have a choice. Well, obviously, particularly in the current environment, we wouldn't necessarily go there. But we do have this remit to go global, and we will do that. But there is nothing at the moment in India, if I could put it that way.
Okay, look, we are drawing towards the end of the time we have allocated today. We've got, I think, time for one more question, which is, you've recently re-entered the US market by buying a business previously owned by Next Control Systems. Can you explain the rationale for the acquisition and how are things going since making the purchase?
Okay, well, the rationale was that it gives us a company, a small company, admittedly, but a company that is profitable, that operates in the US market with if you like, operations already in place. So that's pretty valuable for us. And the US is a key market. We think it might be 5 to 7 times the size of the UK. And it's going to be the biggest market at the moment for this type of technology. So we kind of have to be there. Now, how have things gone? Well, I would say so far excellently. Okay, Aylsa, do you want to add anything to that?
Yeah, I think so. I think Kit talked about it as well during the presentation around the move to globalization, and I would say the integration. There's been a good integration plan of the Tutela LLC, bringing Steve Peck on board as well as the new US managing director. I would say it's definitely going well and showing promise. Kit's already talked about conversions of contracts and leveraging some of those learnings that we had in the UK last year that delivered those results. So yeah, so far so good.
Wonderful, thank you. That brings us to the end of the time we have available today. I'd like to just remind people, if they wouldn't mind answering the survey as they exit, that's really appreciated by the management team. I'd like to say thank you for the management team for presenting today, and thank you for everyone who's attended. A reminder of a few future webinars that we've got coming up over the next month on your screen now, and if you want any further information about those, you can either email info@yellowstoneadvisory.com or go to our website. And I'll conclude by saying thanks again, and we hope to see you all soon.
Thank you.
Thank you.
Thank you.